Welcome to a presentation on valuing infrastructure assets, an auditor's perspective. The presentation was given to the Queensland CPA Congress on the 15th of October 2015. So to set the scene today, I'm going to introduce three themes. And as you'll see at the top right of the slide, collaboration, practical, where we will share some practical insights into the technical challenges of valuations, and governance. We can't avoid the governance aspects of valuations. I'll start out with some simple diagnostics of the value of state-owned infrastructure assets in the Queensland government and local government sectors. I will then convince you as to why this aspect of the annual financial reporting cycle is so important to us and more importantly to you. Another discussion point that we need to cover is the use of experts, and we don't have to be alone in this challenge. In fact, the more we get together, the more we collaborate, the more we learn from each other, and the easier and more cost-efficient it should be for all parties. I will then go on to discuss the valuation approaches available under accounting standards, but before that, I'll discuss some of the common problems I've seen of recent times in the for-profit government sector. And just so that we all know where we stand at the end, I'll talk about the roles and responsibilities within your organisations to ensure a successful valuation and financial reporting season, and to help ensure as well that you get as little grief from your auditors as is possible. If we leave local government out for the moment, property, plant and equipment makes up 3/4 of the over $300 billion in total assets reported by the state. Now if we just look at infrastructure and add local government back in, the donut on the left shows that infrastructure assets are valued at just over $200 billion. And this $200 billion excludes land. So the local government sector makes up just over 1/3 of this value. The general government sector of mostly government departments and stat bodies makes up 40%, and the for-profit public financial corporation sector makes up about 1/4 of all other infrastructure. Now if we look at the donut on the right, you'll see a dissection of these infrastructure assets by class. We can see that road-related assets make up 1/2, buildings about 20%, and electricity, water, sewerage and waste networks, when combined, make up about 25%. Now while I haven't diagnosed this any further for you today, at QAO we often drill into this data even further as we aim to provide further insight into asset data of our government organisations. So where might you find out more about this insight? Well, we have upcoming Auditor General reports to Parliament. These reports will be hosted on YouTube, and so you can also get there via our LinkedIn page as well. So just search for Queensland Audit Office. As I said, we have reports due to be tabled in the Parliament shortly that will not only inform parliamentarians, public sector organisations and the broader general public. These reports will provide not only the results of our audits, but an analysis that covers the whole of government, the state sector, the P&FC sector, and in the new year, the local government sector. So why are valuations of infrastructure an area of audit focus? So just looking at those numbers, it is pretty obvious the importance that we should all be placing on these assets. Usually the first reason why is due to materiality. We gravitate to the material balances, so we naturally need to place greater audit emphasis on those balances as they have a lower margin of error compared to immaterial balances. We have found that valuation processes often involve complex methodologies and significant estimates that require the use of internal and external experts. We've observed significant differences in professional opinions exercised when organisations have changed valuers and the experts they use. A change in the unit rates for one local government roads from one year to the next had a $200 million or 67% impact. Why should we all be interested in this? Is because the valuation of assets will affect future depreciation expense, which in turn impacts operating results, funding and pricing models, and long-term financial sustainability. Let me give you another example. So one of my clients this year decided to do some benchmarking to other like industry companies to estimate the asset lives for a material class of assets. They ended up revising and significantly extending the useful lives to what they were previously estimated at. Now in doing so, they reduced their annual depreciation expense for those assets by over 60%. So some of the key aspects that were not only considered but documented by this company in arriving at this outcome were as follows. They did a detailed assessment of the economic benefit of those assets to the company. They benchmarked with like assets which had been leased by the Queensland Government previously for extended periods. Maintenance programs had been considered to ensure the reliability and capacity of the assets to continue to deliver high quality services. The effect of the assets' usage was considered in conjunction with maintenance programs, and these did not diminish the ability to continue to generate revenue. And there was no legal or technical restraint on the company to continue to use the assets as intended for the revised and newly assigned longer lives. From this example, we can see that financial reporting professionals can come under increasing pressure to achieve financial results. If organisations cannot present well-documented and unbiased positions and work papers to support estimates and changes to estimates, you are increasing the risk of a disagreement between management and audit over a significant account balance. I'm sure you will all agree with me that reliable asset valuation data is essential for all organisations to not only achieve financial reporting targets and other obligations, but more importantly, reliable asset valuation data can enable more effective asset management planning and budgeting. Now, asset management is a bigger and even more important topic than asset valuation. But we should not overlook the importance of how effective asset valuation data and practices can reliably inform asset management. So I hope you can start to see that we all have our own responsibilities and motivations to get infrastructure valuations right. This slide is a quick recap of our obligations, but as auditors we can't achieve the third and last obligation listed there if you cannot help us and share in the responsibility of achieving the first two obligations in partnership with us. Let's turn our mind to the use of experts. I met with about half a dozen different valuation experts this year, and they certainly bring a bank of information and experience to the table that helps us all. But organisations should never overlook the expertise that already exists within your own organisations. As the slide says, internal experts play a critical role, and there would be probably very few reasons why, as an auditor, we would not accept assessments done by internal experts and asset managers. Now, while there is always a risk of bias that we would need to mitigate, when internal experts are available, they should be used, their opinions documented, and valuation work papers should reference these assessments as well as key meetings. Meetings on valuations between critical internal stakeholders and auditors on, say, a quarterly basis should be considered, rather than leaving it until May or June each year before the annual valuation crisis is raised. A recent experience I had is that when hiring external experts, entities need to be very clear about how you instruct them so that you can achieve the right outcome. The right outcome being great asset data, independent asset condition assessment, confirmation of the accuracy of your useful life estimation process, and obviously market-based costing information. Now, there is also help out there in the form of Queensland Treasury's non-current asset policy for the Queensland public sector, and this is an excellent resource because attached to this policy is an example pro forma letter that outlines what to consider in instructing your valuer. This can be easily adapted by organisations so that you set the right scope and get the right result. So while we as auditors are naturally required to be objective and independent, That doesn't mean we need to be excluded from the process. The earlier you start the dialogue and frequency of communication between management, engineers, asset managers, valuation experts and auditors, the better and more efficient outcome is likely to result. Also, from my experience, it's really about getting down to whatever those points of difference that may exist between management, valuers and auditors, and investing the time to resolve those. The sooner we all get to a common understanding of whatever those points of valuation difference are, the sooner they can be resolved. So when experts are being relied upon, it's important that management must take responsibility for understanding the methodologies and assumptions used in their valuations, and to ensure that those valuations are reasonable and are consistent with the requirements of accounting standards. Relying on valuers and auditors does not diminish management's responsibilities. So to sum up this section on experts, take the time to understand the valuers' methodologies. Valuations can be performed by internal experts, particularly for components routinely constructed each year, such as roads or pipes. The scope of the work should be clear, and that it will satisfy accounting standards. Work towards those points of difference early and aim to build consensus. Valuation approaches. So under the standards there is of course the choice of the cost model on the left or the revaluation model to report asset values. We will not focus on the cost model today, but only on the revaluation model, as this is what is most common in the government sectors. Going to spend a few moments outlining our experience with these approaches, as there are pros and cons. But remember, the choice and justification of the right method remains the responsibility of organisations. So despite what perceptions auditors or valuers may have created for you, it is neither the role of the expert valuer or the auditor to determine which valuation method is selected. In saying that, if you choose the wrong one, you should rightfully expect to be challenged by both auditors and valuers. So under the revaluation model for estimating fair value, we are first asked to consider the market approach, which is the price of a recent arm's length sale of a similar asset. And this is the first preference under the standard, as it maximises the use of externally observable inputs. This is not all that common for public infrastructure, except for valuing buildings located in active markets that do not have specialised purpose. The important point here is that you must look for market-based information first. Under the fair value hierarchy, you can't just assume current replacement cost is the answer. Typically, the assets have to be specialised assets where there is no market before you jump straight to current replacement cost. If we look at income-based approach, which we all know is the discounting of estimated future cash flows to present value, now there is a preference for for-profit entities if market prices are not available, as it is more effective in capturing changes in market conditions and economic obsolescence. Now, in one industry I've been involved with recently, this industry has moved away from current replacement cost to the income-based approach, because under the replacement cost method, it is not readily possible to reliably estimate the value of economic obsolescence or unused capacity in infrastructure assets. In saying that, it may be worthwhile for for-profit entities to still obtain replacement cost values from time to time for asset management and budgeting purposes. Now finally we get to the cost approach. But before that, I want to reflect on some of the more common problems we have experienced in organisations using the income-based approach to estimate fair value. Some of these problems you can see on the slide relate to inputs and assumptions being adopted but were not supported by work papers and evidence. These inputs and assumptions were not always considered by audit committees or boards. Quality control procedures over the model did not exist in some situations. And long-term profitability margins were forecast to increase at rates more than what had been historically achieved, and these forecasts were often not backed up by evidence. What we have found is one possible solution to better documenting valuations and their inputs and assumptions, and that is to develop a workbook for your DCF models where all authorised inputs, assumptions used can be centrally stored, monitored, updated and evidenced. The next part of the presentation will focus on the cost approach, as it has proven to be the most problematic in terms of interpreting and applying. The cost approach to fair value is the full replacement cost less accumulated depreciation. If we look at the slide and the road and the elements on that road, we will cover off on modern equivalent, obsolescence, disaggregation, consumption, residual value and useful life. Now remembering, full replacement cost is the lowest amount at which the gross future economic benefits less any permanent excess capacity could be obtained in the normal course of business, while accumulated depreciation is the proportion of gross service potential excluding any residual value that has been consumed to date. One of the key elements in estimates in the judgments under the current replacement cost method is obsolescence. There are three types of obsolescence: physical, functional and economic. I'm not going to go into those in any more detail today. Let's turn to modern equivalent assets. AASB 13 states that the cost approach to measuring fair value is based on the cost to acquire or construct a substitute asset of comparable utility adjusted for obsolescence. Therefore, the fair value of an asset is based on a substitute asset rather than an exact replica. The bridge on the right is a modern equivalent asset. The valuation of a wooden bridge on the left should be based on what it would cost to build a bridge of equivalent capacity, for example 2 lanes, using current engineering design and safety standards, construction materials and production techniques. The modern equivalent asset should also exclude the following, which would not be replaced by a market participant buyer: redundant components, any gold plating, or any permanent surplus capacity or economic obsolescence. Another factor we need to consider is the disaggregation of assets. Each significant part of an asset with a materially different useful life must be depreciated separately. While the standard specifies that a part is assessed for significance relative to the total cost of the item, we consider that the capitalisation threshold is a good proxy for identifying significant parts. The accuracy of valuations is likely to increase with the level of granularity applied. Revaluation movements can be better understood through greater drilling down of data. Where the cost of replacing part of the asset needs to be capitalised, the carrying amount of the replaced part is required to be derecognised, regardless of whether the replaced part has been depreciated separately. Breaking up assets into parts improves asset management planning and budgeting by providing an understanding of when parts are due to be replaced and how much replacement will cost. This photo illustrates the components of a road: seal, pavement, subgrade and earthworks. Separate recording of each component is important because each component is characterised by different materials, production techniques, and therefore have different gross replacement costs. It's also important because useful life increases as components get further from the surface, and therefore depreciation expense varies. We have noted recently that a number of entities have changed their road components, and that this has impacted on valuations and depreciation, proving that this is a key area of estimation and judgment. Segmentation. Segmentation usually involves separating linear assets such as roads and pipes into parts that are either of equal length or between common identification markers such as road intersections. The segments of an asset can have different useful lives where they have been replaced at different times in the past and or are planned to be replaced at different times in the future. We also look at components and segments in terms of subclassification by shared characteristics. In the photos you see on the slide there, three different possibilities there. We have urban, coastal versus mountainous terrain roads, and then rural and rolling. Each subcategory has a different unit rate for valuation, that is replacement cost, and potentially a different useful life. We also need to consider the material of assets such as pipes like lead, polypipe or concrete, and its replacement cost attributes. Useful life is also an influence, as you need to consider the proposed renewal treatment, for example replacing the linings on pipes. Unit rates. Engineers often refer to the initial construction of an asset on an undeveloped land as a greenfield situation, and the subsequent replacement of assets as brownfield. Now, accounting standards don't refer to these terms. Selection of greenfield or brownfield rates is a key point of judgment, as they are often materially different. However, the size of the difference is often overstated due to some errors in calculating brownfield rates. Some of these errors include that costs should be allocated appropriately to all of the assets impacted by the replacement. For example, the cost of installing water pipes below the ground should exclude expenses relating to restoring incidental damage to the road or footpath above the pipe, as these are separate assets that are valued separately. Savings available from recycling should not be included, as the market participant buyer would not be able to obtain the recycled material without charge. Instead, recycling parts must be recorded, valued, and depreciated separately where they are significant. And this is consistent with the AASB's recent views on residual values. The brownfield rate for assets that will not need to be replaced is nil, as these assets have future economic benefits. They have value and therefore should be measured using greenfield rates. Conversely, greenfield rates may not be applicable for assets that cannot be feasibly replaced on greenfield sites, in which case brownfield rates are required. For assets that can be relocated, the market participant buyer would choose the lowest cost option. Another major estimate and judgment to consider in unit rates is external data, such as the Road Traffic Alliance rates. This may be necessary to take into account local known factors which are reasonably considered to impact on the unit rate estimates. An example of this is access to gravel. Is that gravel beside the road you are repairing, or is that gravel 200 kilometres away, and hence you'd be required to incur significant haulage costs? Another significant attribute to consider in the estimation process is the pattern of service potential consumed. While there may be some situations where condition-based valuation materially reflects the consumption of an asset's service potential, our view is that the service potential for the vast majority of public sector infrastructure is consumed evenly over their useful lives, in which case a straight line approach is required. For example, houses and buildings. The potential to accommodate residents, staff or patients, for example, is the same from one year to the next. For roads and bridges, these assets have the same traffic capacity each year. Drains. Drains provide service potential whether or not stormwater flows through them. They do not consume more service potential when it rains compared to when it does not rain. A drain is not considered to have less total value if the total rainfall over its useful life is lower than what might have been anticipated when it was constructed. Dam walls. Service potential is to store bulk water so that it is available when needed. The consumption of this capacity in any one year does not vary according to whether there is water in the dam or how much water flows into or out of the dam. In terms of valuation, the objective of the current replacement cost technique is to measure the cost of replacing service potential with a substitute. This is different to the cost of replacing an asset's physical condition or returning the asset to as-new condition. Take, for example, a component that is given the same condition rating when revaluations are performed 5 years apart, with no capital works having been performed between those revaluations. All else being equal, many valuers will leave the asset's valuation unchanged because the condition rating has remained static, meaning that there will be a revaluation increment at the time of the second revaluation equal to the depreciation expense recognised for the previous 5 years. While it may be true that there has been no significant deterioration in the component's condition, it is not true that there has been no consumption of service potential over the 5-year period. The straight line approach still addresses physical deterioration and obsolescence. Let's look at physical deterioration. Actual condition ratings can be plotted against expected condition curves to identify whether assets are physically deteriorating faster or slower than expected, and estimated total useful lives can then be adjusted if necessary to reflect variances between the actual condition of the asset and previous expectations. Changes to total useful life estimates impacts the accumulated depreciation formula, which in turn impacts the fair value measurement. Let's look at obsolescence. Functional and economic obsolescence are captured either in the gross replacement cost through the modern equivalent asset concept, or by shortening the total useful life when calculating accumulated depreciation. The next element to consider is useful life. Useful life should not be based on the maximum period it is possible for an asset to exist, but rather the number of years an entity expects to use it. So, for example, while the core structures of some buildings can last for more than 100 years, most non-heritage listed buildings are demolished before they reach this age, supporting a shorter useful life estimate. While the change in assets condition over its useful life is not usually a measure of consumption of service potential, as discussed earlier, it does impact the estimate of remaining useful life, which in turn impacts on the calculation of accumulated depreciation. Factors to be considered and documented in assessing whether service potential of assets have changed include the scheduled date of replacement per the Strategic Asset Management Plan, differences between current condition rating and the previously expected condition ratings. For network assets, the portion of the network that is typically replaced each year, obsolescence, such as changes in demand for the product or service output of the asset, past experience with similar assets, including those that have recently been retired, the maintenance given to the asset to the date relative to budget and changes in budgets for future maintenance, and comparison with estimates used by other entities that control similar assets. The last factor to consider is residual value. Now, the recent decision by the AASB and the inherent restrictions over selling parts of infrastructure assets for a material amount before the end of their useful life means that the residual value of infrastructure assets held by not-for-profit entities is usually the scrap value obtainable at the end of the useful life. Now, given the short time frame available to implement the AASB's decision in 1415, we have been accepting pragmatic solutions for estimating the impact of the change. This is usually via spreadsheet, but from 1516 onwards, we are expecting to see the enhanced componentisation required for recyclable assets to be captured in asset registers or in asset management systems. Now, the role of management is critical. We can't forget how critical this is, that management must develop a reliable and timely revaluation plan that must include the monitoring of both internal and external experts. Management needs to understand the key judgments and estimates applied, and then that will come together in an informative evaluation report for either the board or the Director General or the Council. Another key player is the Audit Committee, and the role of the Audit Committee is vital because the Audit Committee needs to build the revaluation process into its meeting schedule throughout the year. It needs to review and approve the revaluation plan and the report, and it needs to monitor progress. But most importantly, they need to review the reasonableness of judgments and estimates used in the revaluation process. So to wrap up today, some takeaway themes from this presentation is really around collaboration, and that if we all get together earlier on in the piece, we can work on those points of difference and resolve them in a timely manner so that we get the right result for those in governance so that they can perform their role. Now today we've provided you with a lot of practical theory, particularly in relation to current replacement cost, and we hope that this presentation has been of benefit to you. You can also access this presentation if you do a search via LinkedIn and if you search for the Queensland Audit Office. Thanks for your time today in listening to this presentation.